So yesterday was a pretty brutal day in the market, down nearly 2%, and that was on the heels of another negative day. So far today, we are slightly in the green. It's in the morning on the 22nd, but we are quickly heading down. And if we zoom out a little bit, there is a solid chance that this bull market in the first half of the year is finally switching off. And in my portfolio all time, we're about to enter back into the negatives. So that's exciting. To celebrate the occasion, I did buy another $500 worth of stocks yesterday when the market was tanking. This went into QGrow, IXN, and XYLG. Now, I don't want to get ahead of myself too much because the market only just started to turn negative, and there's a chance this trend could continue or not continue. We really have no idea. One tool that I use to help give me some clarity in the moment is the VIX, which is a measure of fear and volatility in the stock market. And this tends to spike when the market goes down. So we can see the COVID spike and the elevated levels during the bear market of 2022. And we have some research that says if you buy into the stock market while the VIX is above, I think the number is like 30 plus, really the higher the better, it will give you better returns over time. And just by looking at this chart, we can tell that's very true. If you buy when this is elevated, that historically is cheaper points in the market. And right now, if we zoom in a little bit year to date, the VIX is beginning to move up, but it still is at a fairly low level, 16.87. So if this continues to increase and the market has more volatility, my plan is to buy in more heavily as this reaches 20, 25, even 30. And that's why even though I have 15,000 bucks of cash sitting in my portfolio that needs to be invested in equities, I only bought 500 bucks worth when the market was down 2%. But in today's video in particular, I want to talk about one of my investments, ticker SCHD. You guys know this is a very popular dividend growth ETF, but recently the performance has been a little bit lackluster. It's behind that in the market. If we switch to the year-to-date view, this becomes a lot more evident. Down 2.78% while the market is still up 14.8%. And due to that, I've seen lots of articles recently that are very bearish on the ETF. In a lot of cases, these are the same authors that a couple of months ago, when SCHD was outperforming, were very bullish on the ETF. With that said, I think there is a legitimate reason why SCHD in the current environment is indeed struggling. So as a shareholder of SCHD, let me go ahead and give you guys my thoughts on this whole topic. The first thing that needs to be said about SCHD is the fund itself hasn't changed, and it probably will never change. The index, the methodology, even the top holdings really hasn't changed much recently. What has changed is the overall macro business cycle and the interest rate. So far this year, the market has been way more aggressive and bullish. That is a stark difference from just last year when everybody was looking for defensive dividend-paying companies such as SCHD. So that's point one. The overall macro sentiment has changed a little bit, and that's why we see funds like technology doing extremely well this year, up 30%. But I think the bigger factor that's affecting the, sentiment around SCHD is the current interest rate. It's sitting at 5.25 to 5.5%. And the Fed recently had a meeting. They came out and said that most likely we're going to keep interest rates at this elevated level for even longer than previously anticipated. And this has a direct effect on income-producing assets like SCHD. A couple of years ago, when interest rates were near zero, SCHD, offering its 3% dividend yield with some potential for capital growth over time, was a really compelling package. But now and in the foreseeable future, we have treasury ETFs like ticker SHV, which brings with it nearly no risk and a 5% interest rate. So if you're somebody that's looking for high levels of income and low volatility, treasury bonds, at least right now in the short term, are just better than something like SCHD. Now, a lot of people that want low volatility and high levels of current income realize that exposure to equities long term most likely will give them better returns than bonds. And for people in this boat, we have names like JEPI, which often in this environment is more attractive than SCHD. So this has grown to nearly $30 billion in assets under management. It gives you some exposure to the upside of the equity markets. But the real selling point here is the yield. This pays out nearly a 10% dividend paid out on a monthly basis, which makes it very competitive with bonds in this environment, giving you a reason to assume this extra risk. So hopefully you can see here that no fault of its own, just due to the overall macro environment, SCHD is in this weird kind of middle position where bonds are safer and generate more income, and enhanced dividend funds like JEPI and Divo give you exposure to the potential growth of the equity markets while compensating you for that extra risk with a high level of competitive monthly interest. So in my opinion, that is why right now in this current economic cycle, SCHD is struggling to gain any traction. And this is nothing new. If you look back at the 5-year history of SCHD against the rest of the market, we do see this cycle of cyclicality where SCHD has a period of underperformance followed by overperformance and then underperformance again. So the last time SCHD underperformed was directly after COVID. This is when everybody thought that companies that were not digital in nature were about to die off. And during this time, which lasted a full year just about, SCHD was really far behind the market. Then as we moved into the crazy bull market of 2021, SCHD did recover and slightly surpass that of the market. And then it really shined during the pullback of 2022 when the more defensive income producing assets held up better than the rest of the general market. But just recently we entered a new phase where people are more aggressive with their allocation, more technology and growth stocks, and those that want income could just get a 5% bond instead. So if you want my opinion, I think this period of underperformance will last a good bit longer until something in the macro environment changes, whether that's a bear market like in 2022, or most likely interest rates are cut and that whole equation becomes different. And once that happens, it is very possible that SCHD will repeat its history and enter into a period of overperformance. But that's just my thoughts. Let us know your thoughts in the comments below, and I'll see you guys in the next one.